Hello everybody. Hello everybody. Hello everybody. So I wanted to quickly make this live stream. Hopefully you guys can all see it. Hopefully you guys can all see it. Yeah. Wanted to quickly make this live stream as the FOMC meeting has just started and the interest rate decision has been made apparent and it's gone from 4 to 4.5. So we just got ourselves a interest rate hike of 0.5, and without making an entire video and keeping you guys in the dark for a little bit, just wanted to quickly get a stream going talking about what I think is going to happen next and why this is so important. However, again, the number is 0.5. Just announced about a minute or a half ago or so. About 5 minutes ago, I put over on Twitter, be prepared as it's about to happen in 2 minutes. We just got it, and it's, again, 0.5, aka 50 basis points. Fed raised interest rate with 50 BPS. Let's quickly put a little tag on there. There we go. Because, again, it just happened about 2 minutes ago or so. I wanted to quickly make this video out to you guys. You cannot see it even here just quite yet. You can see the forecast was 4.5 and it turned out to be 4.5, which at the end of the day is a very, very positive thing. We already talked before about how it has to be slowing down. We watched a meeting, I think a week and a half ago, I think 10 days ago and right now, where Jerome Powell basically said, hey, things have to start slowing down. But I also covered in a video, I think 2 days ago or so, something along those lines that the number doesn't matter too much. 4.5, 4.7, whatever the number might be, it doesn't matter too much. Mostly having to do with the fact that it's about how long it will take to get back to a reasonable inflation. What I mean with that is right now, the interest rate can actually go up to, who knows, 11, right? If they keep upping it, albeit deteriorating, right? They keep increasing it with a slower curve, so to speak, it's still going to be increasing. And so in theory, we could be increasing this interest rate for another year and a half, all the way up to 9 whatever percent or so. It's about how high it goes and how long it stays at that high level. Again, we've talked before, you don't want to go and get a hard landing. You don't want to go into a full-on recession. And so what you don't want to get is where your growth is negative, where your growth is deteriorating so much where economy just can't keep up, basically, right? It's direct consequence with each other, if you understand. But so what they don't want is for the interest rate to be too high, where the cost of capital literally is too high, where, well, people are not going to invest in new things anymore. Apartment complexes, you can't build those logically if the interest rate is too high because the cost of capital is too high. And this is more of a longer term play and a kind of like an emotional economic thing in essence. In reality, not necessarily, but the higher the interest rate, the more likely it is that people will extend their consumption into later in the future, which again means they will buy less stuff, which will in turn also mean that the price per cost has to go down. But at the end of the day, that's also because, well, people are saving more money. We talked about this entire little loophole of things. Buying less stuff, so the purchases go down, the production has to go down logically, and potentially wages can go down in that little loop, even though that's usually not the case. They just go up less. You guys don't understand what is going on with all that. But yeah, just wanted to quickly get that out to you guys. Yeah, it's a very interesting decision. I had honestly not expected that, as I thought they would go on with another 0.75. He kind of made clear that that was most likely what was going to happen. And so I'm pretty surprised. Then again, we actually, for the last couple of days, already kind of, I'd say, changed our rationale to thinking lower, as that was what the polls were saying all this time around, you know? So yeah, that was what that's what all the polls were saying. So that's obviously what we go with. The new interest rate is 4.5 indeed. This number has not updated completely just quite yet. Let's see if we can find it. It has still not updated perfectly. But yeah, here it is already. You can see 4.5. Oh, sorry. Let me quickly get you guys. 4.5 is what the newest number is at. You can see their interest rate projections have also now been announced. I don't personally think they're too exciting. The most exciting thing is this Fed conference, which starts in about 25 minutes from now. Honestly, I'm not too sure. Is there any speech going on right now as we speak, or does it only start? Because I'm never so sure. I guess I'm not so sure if the numbers are just announced behind closed doors, or if we actually get to see any of the talks right now already. Let me quickly see what you guys say in the chat box. What do you guys know about that? I mean, let's also quickly look at the price. A lot of you guys are saying things are falling. Let's quickly take a little bit of a look. Crypto throughout the day has been doing exceedingly well. It's actually been really fun to watch Bitcoin for the first time in a long while just perform. Just perform at all, really. Yeah, here we go. Look, oh, wow. That was a big pitfall then, huh? Damn. So it went from about 18.35 or 18 point, yeah, let's say 18.38 all the way down to 17.8 in a matter of minutes. So down about 3% in 6 minutes. That is actually pretty wacky. That is pretty wacky. Yeah, just obviously right after the interest rate announcement, or the interest rate announcement came out, which is actually kind of surprising. Somebody said, or Sean says he thinks the ECB was speaking today as well. Not sure about that, buddy. Not sure about that. At least I don't see it in the list of things which are happening today. So I wouldn't count on that if I were you. Tomorrow we have the ECB interest rate decision. Maybe you're banking on that one. That is over on the 15th. And then we have the council meeting somewhere as well. Tomorrow, that is. Not sure on the timing of that. And then we have a little bit more on the interest rate. Not important, these ones, to be honest. But that's what's happening the day afterwards, over on Friday. But yeah, the most important one by far was the Federal Reserve interest rate decision. And potentially the projections to kind of see what they're saying, which is what we're basically getting right now. However, don't know if you guys know if there's any talk going on before 30. Because we all know the conference. We all want to watch that, I think. But is there any sort of information that we get before that? I know the numbers are out there, but do we get any live footage? Do you guys know? And everybody, if you're watching this live, make sure you press that like button. Again, I don't mean too much with this live stream. All I want to do is just quickly go over these numbers. Hopefully make it a little bit of sense. And that's about it. Again, I'm still struggling. I'm not sure if I told you guys before in the video. I just bought myself a new Sony a7S III camera. And I still don't know how to use it, actually, to be honest. But I'm trying to set it up. I have a big new lighting setup and everything. I'm trying to make it even better. You know? I've been trying, man. I've been trying to make this the highest quality I can. I'm trying my best. I'm trying. But yeah, I also try to do daily live streams, right? Until I have to go to Rome. And I'll get a couple of videos about that in soon as well. Nuts the Boy says, are you going to continue covering XRP after the lawsuit ends? I want you guys to know, I covered XRP a long time before the lawsuit started. Just want you guys to quickly understand that, all right? It's not as if I all of a sudden started talking about XRP because of the lawsuit. The lawsuit happened, and it kind of made me stop talking about XRP until we noticed, hey, we can actually just, I guess, cover more about this lawsuit. But, yeah. Is Nike paying you to advertise their hoodie? That could have been pretty cool if they were, huh? But unfortunately, no. That would be pretty nice. Dow Jones is dumping. Yeah, most likely Bitcoin dumping means the Dow Jones and potentially S&P are also falling down. It would make the most amount of sense. But that market is not doing good right now. Look at that. It just crashed 3-point-something% within 6 minutes. 3.1%. It's recovered already about 1%. But it's going to be interesting to see this flow over the next hour or so. I'm just quickly trying to see if there's any sort of content that we can watch already. Jerome.
For the JP press conference.
No. Nope. Just checking with some other people. You guys understand what I'm trying to do, right? Just trying to look around a little bit, but no. Nothing that I can find. So we're going to most likely get that speech in about 19 minutes from now. We have Bloomberg as a conference going on, but there's also nothing crazy to be said. It's about the intraday numbers. Treasury extend declines 2 to 10-year yields today's high. That's all has been said right there. Of course, Bloomberg, I think, is live all the time, to be honest. I think they're literally live 24/7 or something along those lines. It's already been live for 12 hours, so that's not so special. And no, for the rest, we just are going to get ourselves the juicy info in about 19 minutes from now. Dusty, please send the link to the page you showed with all the events. So this is the economic calendar. It's called tradingeconomics.com/calendar. I show this in almost every single video where we talk about these numbers coming out. So just check it out for yourself. It's very useful, trading economics. Yeah, and it just showcases all the times that important numbers come out. It's it's pretty obvious, I'd say, but you can also type in for yourself. Has anything happened yet? We just got ourselves the interest rate decision, and I'll type it in the chat. Interest rate has been increased with 50 BPS, now at 4.5%. I'll put it in the chat pinned. There we go. There we go. So again, I just want to quickly come back to the initial point which I made at the start. You guys got to understand, we've covered the Jerome Powell speech. And he's basically said to us already, and I think in a really easy manner to understand, things are going to be getting worse. We are going to see a continued couple of months, couple of years potentially, at least I'd say another 6 months of increased interest rates. What that means is we're not too sure how the economy is going to react for the next 6 months at least, because in theory, interest rate increases are very bearish, very bad. They combat inflation, which turns out to be a good thing, and depending on how hard you fall, depending on how hard the GDP growth basically goes down, which is the difference between a hard and a soft landing, basically, and potentially how much the unemployment rate changes and how many people lose their job because of things changing. As we said before, to oversimplify it, it's a very simple circle. It's a very simple loop, where, as I stated already, but I just want to quickly remind everybody again. So the higher the interest rate, right? The whole problem here is inflation, okay? Let's just call it, this is a very textbook type of definition. The whole problem is inflation getting too high, the price of things going too high. So what do you want? You want people to spend less. That's, at the end of the day, what you want. You want people to spend less and basically, I'm not sure if this is the right way to phrase it, but lower their consumption on the short term. I think you have a natural propensity to consume, which is going to be always there. You're always going to consume something, but you want to lower it as much as possible, that they do it now, and they're going to do it later in the future. They want to extend their consumption to the future. How can you do that? 2 ways. One is to basically deter them from spending anything because the interest rate is too high, the savings rate is too high, so they keep it on the bank. And the other is that they don't actually go borrow money to invest in new things. Because what happens in this whole circle is the more that they invest in things, the more money that they borrow to do this. And the costlier it is, the less they do it. Sorry, the more they do it, the higher the prices go. As obviously there's more demand for it, so they can build more. It's going to be more supply, sort of, but it's mostly just going to be more and more demand for things to be built. Things for this, that, you understand. So again, hopefully it makes sense. In my head, it's so simple, but then to actually put it into words, you start to realize that these concepts are something I should also just think through more often than I usually do, because it's not something I sit with every single day. But then, to just quickly get back on track, the higher the interest rate, the higher the cost of capital, on the short term at least. And so the less likely they are to produce new things. In reality, is that really such a big deal? Well, you can see it with purchasing a home. Right now, if people want to purchase a lot of homes, for example, they're going to have to think twice. Because with an interest rate of 2%, it's very easy to be like, you know what, just grab it in. If the interest rate is 8%, for example, it'd be like, whoa, wait a minute. Wait a minute right there, my buddy. And they're going to have to think twice or 3 times, maybe something along those lines. So what you're doing then in turn is you're deterring people from, well, just borrowing more and building more. And in theory, people will get fired. In theory, people will spend less. So the price is going to have to go down. The demand, in terms of there's going to be less jobs filled. And now you have to kind of balance with how much the unemployment is versus how much the natural rate of unemployment is, which again, you can, through a Phillips curve, can kind of balance again with how high the inflation you want it to be or how high it should be, yada, yada, yada. But the point being, which was the whole point of the story, the higher the interest rate, usually the more you can combat inflation over a little bit of a longer term. This only works, however, if the interest rate is actually above 0, which, because you also kind of have it the other way around to increase inflation, by the way, which again, works really differently with increasing or decreasing interest rates if they're below 0, which is a story for a different day. We'll go over that a different day. I'm also needing to recap all these concepts. Again, guys, at some point I went to university, if you guys probably know by now, and I did study econometrics, fun fact. And he also had finance. And what did you have? Macroeconomics, microeconomics, econometric stuff, data science stuff. It's been a little while ago. Probability, statistics, and all that shkabamel, which I did, calculus, which I did used to enjoy. Fun fact. I wasn't always a crypto boy. Things changed, guys. Things changed. I used to like mathematics, huh? It was good stuff. And now we watch these things. Again, what we're waiting for, by the way, for anybody wondering why I'm just talking like a baboon, we're waiting 13 minutes for the Jerome Powell speech, and I'm trying to kind of fill that gap of just awkward silence with you guys in the chat just talking a little bit and just watching. There's 200 people watching like this. It's kind of scary if you think about it, right? There's just people listening to you every single word. So you kind of got to make up a story, Yeah. We're waiting for 13 minutes. Let's cover, I guess, a couple of the articles that we found, huh? I guess that might be a nice thing to fill up our void with here. So 2 hours ago, Fed meeting, what economists are saying. And it's blocked by a paywall. That is very nice. We have live coverage, though. Let me see what exactly that turns out to. If we press the live coverage feed. Because, again, I don't... Okay, here we go. Yeah. I want to say we don't got ourselves any live footage just quite yet, but why is this so annoying? There we go. But in about 10 minutes from now, the stream is going to be starting, where they cover everything. Ogtrin Rec, what a name. You've been talking to us for years. Don't get scared now. No, it's just joking, guys. Marian says, interest 7.9 on my house credit. That's wild. And just to kind of realize that a couple months ago it was like 2, for example, depending on where you are, I guess, huh? Impressive American accent, being from Netherlands and all that. Yeah, a lot of people actually ask me where in America are you from? And I'm like, but then the moment they point it out, the moment you start thinking about it, my accent just kind of, hey, you guys, yes, you can also talk a little bit like with this accent, And then if you start to think about it a little bit, then it's starting to make a lot more sense to actually make it very simple for myself and talk like a really Dutchy person. You know what I mean? It's also not that hard for me to speak a little bit like this, Insane market short squeeze and center rally just starting. Don't panic. We just get all great news. At the end of the day, a lot of the news that we get right here is not negative, like you said. I mean, at the end of the day, they're slowing down the increase of the interest rate. Can we see that as a bad thing? No. However, on the contrary, you can say that an increase in inflation could lead to a little bit more fear, which could be negative, net negative for these traditional markets, but kind of positive for cryptos. As at the end of the day, we all know it. Inflation shows people why they'd need potentially cryptocurrencies. I mean, cryptos, a lot of them have natural inflation, which if measured in dollars kind of makes no sense then. But if not measured in dollars, it makes a whole lot of sense. And the point being, the more the inflation is in dollar terms or euro terms or whatever, fiat currency terms, well, the more it makes sense to go for something quote unquote stabler or safer. Just for fun, right? Think about this for a little second. Think about this. I've had this discussion many times. Let's say you have 1 million US dollars. What is the safest thing you could buy to have the same, if not more money in 1 year from now? I could say 10, but I know a lot of people would say either keep it in fiat or real estate. But with fiat, you're certainly going to be going down in value. We all know it. In this case, you're about 10% in a year. With houses, well, it just depends on whether or not you hit a good spot. Because at the end of the day, these houses go like this. And it could be that you just bought yourself a shitty house and now all of a sudden you're down $100,000. So real estate, iffy because it depends a lot on timing. It could be you just had a shitty 4 years and all of a sudden you're down $300,000. It could be. So then it comes to what exactly? Well, I'd say the majority of people would say have a diversified portfolio. Get a couple of different things. Get some real estate, some fiat, some potentially crypto, some maybe stocks or maybe some indices. Get some silver, gold, etc. That's I think what the majority of people would say. I think so, right? I think that's a pretty balanced thing. Some people might say supercars because at the end of the day, those, I need to stop saying at the end of the day, those stay pretty solid as well. I think most people that bought themselves Lamborghinis over the last 2-3 years have done pretty well for themselves in terms of return. They've done really, really well. And the same thing can go for watches, you know? A lot of watches, they do exceedingly well in terms of pricing when the markets are okay, or stay stable when the markets are bad. So that is also pretty okay. So if that is the idea, though, and I've said this many times before, I am a really big fan of diversification, and I always diversify whatever we're talking about. I diversify all the time. However, there's a really big con to that, and that has to do with what we had, for example, with UST. As you guys probably remember, I lost a great deal of my portfolio in the whole UST tobacco. It was a multi-million-dollar hit, was not fun, but it was what it is. Now, I said at that time as well, it was diversified enough where it doesn't matter. You know, it's not the biggest of deals, but it still hurt like a bit, still hurt a little bit. Mentally, kind of, but not too much, because I'm used to it, I guess. Crypto veteran, you start to understand, in crypto you'll lose. However, it made me think, man, if I'd not diversified it and just went for the one thing that I had, for example, crypto.com, this wouldn't have happened. I wouldn't have lost a couple $1 million, for example. And there you start to think again, well, but if I had everything in this whole UST crap, I would have lost everything. But yield farming, to some extent, does not become worth it, or some other, I guess, endeavors that might generate you some sort of passive income or yield might not become worth it if you offset it against a risk that you potentially did not even see. So with, for example, this yield farming, let's say it's weighing in 10% a year. Then if I'm putting it into something, it takes me 10 years-ish to get the money back. That means in these entire 10 years, nothing can happen to that specific amount of capital. But if I'm then diversifying, this basically means that I have multiple shots at one of these things going wrong. That's netting me 10% a year, okay. But that also means that if one of them goes wrong, I'm going to need an X amount of years potentially to recoup just that loss, meaning that all the other yield strategies were kind of worthless as they were just paying for the one loss I had by diversifying. I'm not sure if you guys think about this every now and then. I think about that a lot. But that also leads me to the previous point, which is, well, diversification is nice and all until one of your sectors goes bust. And the same thing goes for investing in a lot of cryptos. Well, is it smart to go 20, 20, 20, 20? 20, 20, 20, 20, 20? You know, invest 20% of your assets or your portfolio into 5 different cryptos, for example? Debatable. You know, I personally think go, let's say, 60% into the crypto you really believe in most, then maybe 10% or maybe 20% in the crypto you believe in second most, and then kind of number your way down with a curve like, I guess you could say like this or like this. And that is because I honestly believe you're better just wrong once and it hurt like a big bee sting, instead of being wrong slightly every single time, netting you still almost no profit. And that is why I invest in almost every single crypto that I come across. If you're seeing a video of me talking about some sort of new investment, I could literally do those every single week, 1 or 2 or 3, because I invest in almost every single thing out there, because diversification is key. But I understand, don't put the majority of your money in one of these new things. If there's a new crypto project coming up, Bitcoin is dumping, by the way, it's continuing to go down. If there's a new project coming out, and I'm kind of venting on a couple of different things, but because everything connects together, don't put all your money into them, but it's very often worth a try. But don't diversify too much where if you make it big, it didn't matter. But then if you lost it, well, you guys hopefully understand where I'm going, right? Where if you lost it, hopefully it was a really, really big deal to lose it, because then it was also hopefully a very big payday if it worked. And otherwise, yeah, there's just so many stories intertwining here, guys. Oh, maybe I should just take another video to kind of separately break everything down. There's multiple different strategies that I'm kind of telling you guys at once. One of these has to do with diversification being the key to everything, because at the end of the day, you might go into one investment, lose everything, boom, at least you were diversified. On the opposite end, a reason against diversification is because all the yield that you were maybe getting with all these other 4 of the 5, if one of them goes bust, you're still losing a very big chunk of your money. So that kind of principle goes on further. The reason I invest in many different cryptos is because one of them might do exceedingly well. The reason I don't put crazy amounts of money into all these different things is because all of them might do really bad. Everything kind of put together there. And to go back to this, what exactly would you put a $1 million portfolio into? It's like, well, all of them then have to kind of do good. Otherwise, you could have better stuck with maybe 1 or 2 that would have most likely done good, because otherwise you're always still back at 0 or a slight loss. I mean, at the end of the day, every single thing that I look at is quote unquote risky and is correlated with one another. 3 more minutes to go before the speech. If you invest all your money, for example, into gold, well, at some point, people might realize, gold, In theory, they've said it comes from asteroids, it comes from outer space, it's put onto Earth, there can always be more, it's actually an infinite resource, just potentially finite on Earth with our estimations, but we're not sure exactly how much is out there. It's not necessarily finite, it's just finite to the extent that we've noticed it right now. You know, there could be billions of kilograms worth, I don't know how much, but a lot of kilograms worth of gold at the bottom of the ocean for all we know, right? Who can measure? Nobody really knows exactly. And the same thing kind of goes with the US dollar. Well, maybe the US dollar is not as awesome in 5 years as it was right now. Maybe there's really big crises and the US just loses its position and the dollar just kind of goes on a lira or a Venezuelan whatever dollar thing they had over there, whatever currency they had over there. A lot of this stuff could, in theory, happen. And the same thing for cryptos. Maybe at some point, Satoshi Nakamoto comes out and says, this was all an experiment, big middle finger, screw you guys. Maybe it comes out that the government was actually behind all this. The whole crypto stuff, it was to give us a sense of freedom, just to spit in our faces and take it all back again. Maybe. You know, all these things, which is safe then. With housing, at the end of the day, and this is a broader theory, but a house, it's only yours until it's taken away from you. You can never really own the house. If the government all of a sudden steps up and says, nah, we're going to actually claim that. It's actually ours. Get out. What can you really do? Oh, I'm going to fight it on legal terms. They're going to be in front of your door. The military, they're going to be like, get out. What are you going to do? Defend it? And the same thing goes for gold. You can't really defend it. If push comes to shove, you're still losing that. What exactly is worth something forever? I guess when things get into a really dark period, I guess food and useful utensils, I guess, become the currency at that point, all right? Which is why in prison some other things are useful rather than just actual dollars. But I sometimes think about this whole principle and sometimes might think too much about it in terms of what exactly is smart to put your money into if you have all the options in the world. A watch is only worth much because people give some value to it, even though it's kind of dumb. You know, one of my watches, for example, it could be $50,000 for a freaking watch. Is it worth that much? Well, yeah, because the crazy guy wants to pay for it. Nah, I'm the crazy guy, I guess. Another might be a crazy guy. But at some point, people might realize, I'd rather not, because you're overpaying for something which is still being made, potentially. Stuff like that. The house is only yours until they take it away, and a lot of it is dictated by the fact that people want to rent it for that much money as well. Maybe eventually there'll be new laws in place that prevent people from renting out their apartments at such crazy prices. Let me actually find a headset. Here we go. Which would also crash the housing market, by the way, if all of a sudden they noticed, well, we can't go for these crazy prices anymore. Yeah, and that's just stuff that keeps me busy every day, just thinking about that stuff. I've been venting a little bit, most likely said some dumb stuff, but it's what's keeping me up every day, and I like to share that with you guys. Let's test this real quick, see if we have any sound.
Alice, thanks very much.
It's not in my headphones, that's for sure.
Alice Atkins here in London.
It's not in my headphones still, that's for sure again. Why not exactly? Let us see. Let us think. Why is this not in my headphones? You know what I also hate about Windows frickin' 11? Why is it so hard to find a frickin' little... that little freaking headphones icon somewhere.
London, coming up on the program, EU nations reach...
How do I get rid of this? How do I put it into these things? What do I do? What do I have to do, literally? Oh, by the way, we just had a... Oh, sorry. I just missed it. We actually had somebody join the... Oh, no. Give us a thumbs up. Mr. XRP Man coming at the $2 with a thumbs up. Thumbs up back, my brother. It's live. It's not showing up anything. It's live, but I'm not seeing anything. Guys, if there was only a sound icon, that would be easier. How do I get the sound icon if it's not showing up on the bottom right? I'm gonna throw something at this computer, guys. I'm gonna throw something.
Good afternoon.
Oh shit! No!
Before I go into the details of today's meeting,
I'll just
I'd
mute
like
my mic.
to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves. And many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. That's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Timoros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they can make changes to their SEP during the meeting, well in advance of the press conference so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria?
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation, and where's it coming from? It's coming from the goods sector clearly, By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael,
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So, if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take. And, of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment. in 50-year low in unemployment. Vacancies are very high. Wages, nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that with structural labor shortage is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually. It's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because, they gave us a job and we need to, do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't. Talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. that would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
That was peculiar, to say the least. Did we learn something new is the good question. I watch these speeches every single time. And the next one now, if you're wondering, is going to be here in about 48 days from now. But I really wonder, did I learn something new today? That's a good question. To just quickly show you guys, I'm not sure why my mouse is a little bit kaput. 48 days we have without Jerome Powell's beautiful insights. But what exactly do we learn each and every time? I guess we learn that things are bad. That things are, however, as he stated, not doing that bad. That things are less than optimal, which we can all deduce ourselves. What exactly do we learn from watching him speak? And I sometimes wonder why there's an audience there asking questions when he can't really trade his information that he gives in a speech like this. If he says, oh, we're not in a recession. Okay. Whatever he says, it doesn't really matter that much. And it's just now kind of popped up in my head like, hey, wait a minute. Whatever he says right now, is it really that important? I mean, the rate and whatever that's going to be is quite important. And I'd say a couple of statements, like, for example, the fact that, hey, whatever the number goes to is important and how long it stays there is important, but not, and this is the most important part about everything I'd say, the increases at which we get to that pace. He said, top. People are wondering too much about the pace. Oh, the interest rate increases have slowed down. Yeah, he says, who cares about that? Which is, I think, a really nice thing. We don't know how high it's going to go, right? It's going to go into the 5s. We don't know it. Is it going to go into the 6s? We don't expect it to, but let's just see. And we don't know if it's going to stay there for 1 week, 3 weeks, 6 months, 7 months, 10 months, 3 years. I mean, right now, the expectations of inflation not going, I guess, optimally are all the way towards 2025 already. And I know 2023 is already around the corner, but can you guys just understand that for the next 2 years at least, we're kind of stuck in this loop of negativity? It's just something I've been thinking about. But yeah, guys, that was it for today's little stream. I said a lot of stupid stuff at the start here to fill our void. Right now, this stuff was all pretty cool, though. Cool to listen to. It makes me think again about how much we actually don't need their speeches to understand. I guess the numbers were enough. It gives some insights, it gives some insights into the near future, but a lot of this stuff is just blah, 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 blah. Especially those questions of people asking, well, but what are your insights? He's like, well, just listen to whatever I put in the speech, and I think that's indeed quite right. But hey, that's just my theory on the matter, and I'm just a dumbass, so don't take it too literally. That was it, guys, for today's video. Hopefully you all enjoyed it, and I'll see you guys again in another one. Hopefully you guys will tune in tomorrow again. If you haven't subscribed yet, make sure you do so. I'll see you guys again in another one. All right?